how people can bridge the gap between the wealthy and the ultra wealthy status.
Once you understand the magic of compounding, if you are able to find it channeled into investments that compound regularly, fairly predictably, then the road from wealthy to ultra wealthy is like being on autopilot. I advise 99% of people who ask me, don't try to buy stocks. It's a specialized game.
What have been your guiding beliefs or principles that has helped you to create and manage your investment portfolio?
It's very simple, which is that in the long run, nothing beats equities. Second one is that wealth, once you're wealthy, wealth is intergenerational. And therefore, don't look at time horizons. Should I put all my money into equities now? And I said, no, absolutely not. In any given period of 2 to 5 years, there's a very good chance of a substantial drop. I own a substantial amount of precious metals, both gold and silver. And the reason for that is that I believe that we are in a situation where all the governments in the world are in deep debt and will keep needing to borrow.
How do you view global diversified portfolios?
India represents about 2 to 3% of the global economic activity. Since you can now invest in many parts of the world, why should you only look at India?
The journey of an investor is 100 journeys of growth, of ideas that grow into products that represent change, of businesses that become productive engines of growth and employment. These are the words of our very special guest, Mr. Mohit Satyanand. Imagine if experience of one business or idea gives you 100 journeys of growth, what would dozens of them give you if you experience them as a founder, entrepreneur, strategist, consultant, board member, angel investor, and more? We are talking about a person with decades of deep experience and knowledge. Sir is also our chief mentor and board member of TrueMoney Capital. It is my pride and honor to welcome Mohit Sir on our podcast show, the TrueMoney Talks, presented by TrueMoney Capital. Welcome, sir.
Thank you so much, Ivani.
It's such a pleasure that you have come here. We've been looking forward for this session. My first question will be, how do you personally define wealth? It should be more than money. Is it about more freedom, more experiences, impact?
Great question. For me, wealth is the freedom to do what you want to do and not to have to do things just for money. And at some point in time, if you're lucky, then wealth also produces enough surplus to give back.
Right. So moving on, a lot of people, they've kind of figured out what it would take to become wealthy. With the right business and financial education, they can have a checklist. So much of information is again available as well. Time, discipline, other things. And they have achieved the wealthy status also. But where they struggle is to bridge the gap between wealthy and ultra wealthy. So what are your views on how people can bridge the gap between the wealthy and the ultra wealthy status?
Well, there's two parts to that. Okay. One is my personal belief, which is that you don't need to be ultra wealthy. And the other is that the goal of an organization like TrueMind is to help people become ultra wealthy if that is their desire. So I think the key issue is always the magic of compounding. So once you understand the magic of compounding, if you are able to find it channeled into investments that compound regularly, fairly predictably, then the road from wealthy to ultra wealthy is like being on autopilot, because you move up that road very rapidly. So, even if you look at, let's say, the Nifty, for example, the Nifty has compounded over the last 20 years at something like 11 or 12%. Now, if you say that you're making 12% per annum and inflation is, let's forget the CPI figure, but that your costs go up at, let's say, 6% per annum, that means that your wealth is going to go up by 6% per annum after taking care of inflation, which means that about every 11 or 12 years, your wealth will double. Now, when wealth is intergenerational, or you start investing early, this is a huge number, because that means in 25 or 30 years, your wealth has gone up 5 or 6 times. So if you define wealthy, for example, I don't know what definition you have, if you define wealthy as being 10 crores, and in 20, 25 years you can get to 50 crores. And this is not a nominal number, this is 50 crores after accounting for inflation, then you've certainly moved into a different bracket.
Agree.
Yeah, so it's just about compounding, just sitting quiet and letting the magic of compounding take over.
So, given your vast corporate experience that has spanned into decades across different industries, sectors, giving you exposures to different geographies, business cultures, business ideas, what were the initial money habits or practices that set the foundation for the wealth that you have accumulated today?
I think there are fundamentally two things. First is that you cultivate deferred gratification, which is that you don't have to spend money the minute you get it. And I don't know how much you can cultivate it, how much you're born with it. A lot of it comes from the family as well.
Yes.
And so I was lucky with that, because, of course, I grew up a long time ago. And when I look back at it, our family was very influenced by the post-partition culture. Both my parents were, in a sense, victims of partition. And so there was a frugal mindset. And nothing was spent unless it was necessary. So I think delayed gratification is very important. The other thing is to start investing early. So I don't know how it happened, but when I was in college, and in those days you joined college at 16, I started doing part-time work on All India Radio. And I used to get 15 rupees for a program. And if I worked all week for 3 hours a week, then I would get, I think, 84 rupees. And I would save it all.
Oh.
And then in the early 70s, the equity culture just about began. And I said, I also want to buy shares. And my father encouraged me. And, he was a salaried employee. He was not a rich man by any means. And we had no family house, nothing, because everything was left behind. But that showed me that, you can grow money. First, you need to save money. So it's very simple.
True.
First, you need to save it. Then you need to invest it. And that's it.
Very nice. Yeah. And so then, over the years, any learnings and unlearnings?
I think the fundamentals remain the same.
It remains the same.
Remains the same. I think I understood the magic of compounding quite late. For me, earlier, it was just looking for that thrill that I've put money into a share and a year later it's doubled or tripled. So it was very opportunistic. But understanding that true wealth is built over time, I think that took a long time to understand. And I really discovered that by accident, because...
if it was doubling or tripling, were you selling it after 1 year?
Yeah. Absolutely. So I understood the magic of compounding actually quite late. Okay. Because in between there were, I started businesses, one of them failed, I was back to zero, lost money, etc., etc. But when my father started losing interest in affairs, and he was a very self-sufficient man, but when he was about 80, he started losing interest in his financial affairs, and I started looking at his accounts. And then I found, this was around 2004, 2005, and I saw that he had held shares since 67. And he had a notebook, just a children's notebook, in which all the entries were made in very fine but very tidy handwriting. And I saw that he had only sold shares twice in his life. One was when he built the house in which I now live. And the second is when my elder sister got married. And both times there were small quantities. So I was able to look at the investments over a 30-year period and look at what the magic of compounding was all about. And this was also the time that I first had access to a spreadsheet. Till then, I didn't know what a spreadsheet was. I could feed all this data in and see what happens when a small amount, 400 Hindustan Lever shares bought at whatever it was, 30 rupees, uh, what they're valued at in 2004. So, but today everybody, I think, can and should understand the value of compounding much
more.
earlier.
So buy quality stock and hold for a very long period of time.
Yeah, there one gets into a little bit of detail, what you should hold, what you should not hold. And I think for the average investor, looking at individual stocks is not advisable. It's a very specialized field. And that's why you have organizations like TrueMind, which help you develop your investment profile according to what your risk profile is. And then there are people who are actually doing the allocation and the equity research, who construct mutual funds and ETFs and so on. So I advise 99% of people who ask me, don't try to buy stocks. It's a specialized game. It's like saying, almost like saying, I don't need to go to a doctor. I will treat myself.
Correct.
It may work, but by and large it
Yeah.
doesn't. Yeah.
Very true, sir. Every seasoned investor develops his or her core investment strategy. What have been your guiding beliefs or principles that has helped you to create and manage your investment portfolio?
Well, it's very simple, which is that in the long run, nothing beats equities. Second one is that wealth, once you're wealthy, wealth is intergenerational. And therefore, don't look at time horizons. So I find this question that some people ask, what is your time horizon? I find it a fraudulent question in the sense that it's not relevant, even for someone like me who's almost 70, to say, what is your investment horizon? And I say, because I'm 70, therefore it's only 5 years old. This is all nonsense, Because firstly, you don't know how long you're going to live. Today, people live till 90. My father was 94 when he passed away. My chacha was 99. So, and number two, today, most people from this kind of background, urban professionals or business people, leave substantial amounts of wealth when they pass on. And it is typically intended for either the next generation or for charity, typically both in some kind of mix. And therefore, your time horizon is actually, I would say, infinite. And people find that really funny, because they're used to saying 2 years, 5 years, 7 years. No, it's actually infinite. And all you need to do is to carve out a small amount for specific events. Like I talked about earlier, if you know that a child is going to be married in the next 2-3 years and you're going to contribute to that, carve something out. If you know that you're going to send a child to university and it's going to cost a large sum of money, then you must provide for that.
Cash flow planning.
Yeah. Aside from that, your time horizon is infinite. So I think that's the second. The first, to repeat, is that in the long run, nothing beats equities. Now, within that, I think what does sometimes happen and is that supposing somebody is a first-time investor and comes to me and says, okay, you believe in 95 or 100% equity, should I put all my money into equities now? And I say, no, absolutely not, because in any given period of 2 to 5 years, there's a very good chance of a substantial drop. And if that happens to you, then A, you will be very dissuaded from investing in equities in the long run, and B, you will get a financial shock. Yeah. And therefore, entry into equities should be gradual. But once you get to a highish level of equities, then there are two strategies. One is that you sort of look at the markets and say, oh, at this level, equities are overvalued. Let me take something out and put it into debt instruments or something like that. Or the other is you say, now I've reached this level and it may go up and down, but in the long run, it's up. So I think that is a matter of detail. For me, by and large, I'm almost always 90% plus in equities.
Equity.
Yeah.
Okay. Thank you, sir. So, talking about our wealth management goals, it could be wealth preservation, it could be wealth creation, it could be balance between the two. At this point in time, how do you look at your goal?
I don't believe in wealth preservation. I believe in wealth creation. Wealth preservation to me could actually lead you into an overly conservative strategy where you say, oh, I don't want to, I'm going to put all this money into fixed deposits because I need to preserve this wealth. And that, to my mind, is a very negative strategy because if you look at what's happening in India today, if you have wealth, I mean substantial wealth, and you say, I'm going to preserve this, and so I'm going to put it into fixed deposits, and you get 6% return per annum, and then you pay 30% tax on it, that's another 2%, you make 4% per annum net, that's less than inflation. So you're not preserving wealth, actually you're destroying it. So I don't think there's any way of getting away from the fact that if you want your wealth to keep up, at least with inflation, the only way really to do it is to put it into equities. And if a person is really risk averse, then as investment advisors like TrueMoney do, then you try and understand the risk profile of the person. And for somebody who's really, really very risk averse, you can park a substantial amount in debt instruments, fixed deposits, whatever it is. But all manner of risk-free investments and have a certain allocation into equities. But you can't preserve wealth without taking some amount of risk.
Can you give a broad sense of how you take asset allocation decisions and what is the breakup of your current portfolio into debt, equity, gold, real estate?
I use debt only either when, as I said, there's a foreseen expenditure, and then I don't want the market to take it out, or as a buffer. I personally invest in equities directly, so it often happens that my personal ability to research stocks is obviously limited. I can't research 100 stocks at a time, so I may not see anything that I want to buy right now. So there'll be money in debt. But for me, debt has never been more than, ever, at its highest, more than about 5% of my total portfolio. And that's it at its highest. By and large, I don't believe in gold and silver because they are not wealth creating. They don't generate economic activity. They are a store of value. Having said that, right now, I own a substantial amount of precious metals, both gold and silver. I think by accident, my allocation to precious metals is roughly what TrueMoney is recommending to its clients, which is around 12 to 15%. And the reason for that is that I believe that we are in a situation where all the governments in the world are in deep debt and will keep needing to borrow, and so we may get into another cycle of inflation and or huge deficits. And at these points in time, it's worth holding precious metals. The category, since you asked me the question, it's not a category which I recommend to most people. But actually at this point in time, the largest percentage of my family portfolio is in unlisted equity. I have, for the last 10 years, been increasingly putting money into startups and into private equity. And but especially startups, then that needs to be almost a full-time job. So that's not something that I would recommend to anybody. But since you asked, I've got to be honest. And and I've been lucky. A couple of the investments I've made have been exceptionally fruitful. So as of today, actually, in my total portfolio, between private equity, which is invested through funds, and unlisted equity in companies where I've personally invested, is almost 50%. Yeah.
So, when you take these capital allocation decisions or asset allocation decisions, how do they feed into return expectations? So, do you think about, surpassing a benchmark? It could be our lifestyle inflation rate, or is it a market linked benchmark or any other form? If you just need to probably compare how your portfolio has done versus, let's say, the market.
So I set myself a goal about 10 years ago. Till then, it was all hit and miss. I see something I like, I buy it, etc., 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 etc. And actually, to go back to the beginning, it was really around 2003 that I started taking equity markets seriously. And the trigger for it at that point in time was that suddenly, after 10, 12 years of liberalization and so on, India was for the first time in a situation where our interest rates had become quite low. And I could see that this would lead to an equity boom. And I could see a boom coming, and over the next 4 years, we had a big boom till the great financial crisis of 2007, 2008, but that's a different matter. And around 2013, 14, when I looked back, I realized that I had, by a significant margin and very credibly because of this magic of balance sheets, that I had outperformed the Nifty year upon year. And now we had, as a family, a reasonable chunk of equity, a lot more than what I would have ever projected. And at that point in time, I said to myself, I don't know whether this is accident or whether it is due to the fact that I have some edge or insight, and this can no longer be a hobby. And therefore, I said to myself, I'm enjoying it very much, but I will continue to invest directly in equities only as long as I outperform the Nifty.
Okay.
And I decided that I will allow myself to underperform the Nifty for 1 year. If I underperform the Nifty for a second year, I will stop investing directly and I will put all my money into ETFs. Okay. So this was the decision I took. Today I might say, oh, okay, if I've underperformed the Nifty for 2 years running, I might say, okay, here you go, TrueMind, manage my money for the rest of my life. But luckily I've only done that for 1 year, twice in the last 20 years, but never 2 successive years. And my own CAGR has, on a long-term basis, still continued to be in excess of the Nifty. So that's my hurdle rate.
Yes.
That I need to outperform the Nifty.
So I just happened to attend All India Wealth Management Conference in Mumbai, and one of the questions that popped up was, what is the first decision that one should take while doing strategic asset allocation for a HNI or ultra HNI client? And the expert answered, the first layer of decision, it should not be the asset breakup, debt, equity, gold, etc. It actually should be how much percentage of your portfolio are you comfortable to put in an international portfolio, in a globally diversified portfolio, and the remaining in the Indian portfolio. So how do you view global diversified portfolios?
So I think there are 2 parts to that answer. The first part to it is that India represents about 2 to 3% of the global economic activity, whether measured by GDP or gross value added or market capitalization. So So since you can now invest in many parts of the world, why should you only look at India? So I think that's the first part of the answer. That has to be caveated by the fact that, we keep saying that India is the fastest growing major economy, which to some extent is true. However, it is not the engine of innovation or of new technologies. That has continued to be the US. And within the US, that has continued to be mostly Silicon Valley or the West Coast. And we can see that in our own lives. What do you use every day? You use a phone which uses Android software or Apple software. And I don't know anybody who doesn't use Gmail. And nearly everybody uses WhatsApp.
Yes.
And so on and so forth. And I remember in that same period, 2003, 2004, when I used Gmail for the first time, after switching from Yahoo,
Used to be
I had an
Hotmail as well, I
aha.
remember.
I had an aha moment. And I said, Google understands the consumer. And I would like to own this stock. There was no way for me to own this stock then. And but that got me thinking. And so when it became possible to invest in the NASDAQ via now there are several instruments, but I invested in the N100, which was floated by Motilal Oswal. I decided that this has got to be at least 30 or 40% of my portfolio.
Okay.
And now when I look at it, I kick myself and I say, why didn't I make it 50 or 60? And nothing has changed. The engine of investment of technological growth continues to be there. The weight of the so-called Mag 7, the big 7 tech companies, only goes up. Now, we keep talking about the fact, is this a bubble? Are they overpriced? Maybe. But the fact is that if I look at it personally, there's still a huge buffer. So I wrote about this in 2019 in a big article I wrote for Mint. And I said, this is the way to go. And I've been tracking it since then. So if I had put a lakh of rupees in the NASDAQ and a lakh of rupees in the Nifty at that point in time, the lakh of rupees in the Nifty is now worth about 2,06,000 or 2,08,000, which is not a bad return over 6 years. But the lakh of rupees in the NASDAQ is now worth about 3,40,000. Personally, I see three big inflection points in technology in the last 20 years. Early 2000s, Google. Like I said, I was not able to invest. Early teens, somebody brought to me a proposal to invest in SpaceX. And I made a commitment of $50,000. But I then had to meet some RBI norms of showing a $5 million net worth, financial net worth. Unfortunately, as I said, a lot of my net worth is in unlisted companies.
Right.
And so I wasn't able to meet the documentation needs. At that point in time, the unlisted investment in SpaceX was being made at a value of 40 billion. It's now being valued at 400 billion, and it's still unlisted, okay? Which just tells you that today a lot of great companies remain unlisted. Today, I think, so this is mid-2000s, mid-2010s now, we're mid-2020s. The big thing is AI. And again, as Indians, you can't invest in AI, right? So I don't think it's changing. The center of gravity of technological progress is not moving either to Europe or to India. So for me, anybody who has what we call a home country bias and wants to put all their money into the Indian market, I think is being very, very blinkered. You need to find ways of investing globally. And if you believe that technology drives progress, which I believe as a student of economics, then you need to invest in technology. And
outside India.
Or outside it.
The other question that I have within investment philosophy side, you've just talked about the unlisted space, but how do you see the other new age trends? For example, crypto is there. And I remember last year when I had met you, you were also talking about one special sub-segment of real estate. You were just back from your trip from US and you were mentioning that. So how do you view in taking decisions in investing in certain new age trends?
Yeah, so for me right now, I would say the biggest new age development is AI.
AI. Okay.
See, something has got to have resonance with you personally. There's a lot of talk about crypto. I can understand some of it, but it has no relevance to my life. And therefore, if I make an investment in crypto, it's almost like playing blind in Teen Patti, and so I have a really small stake in crypto. It's almost like a rounding error. But AI, I know, I use AI. And it's been revolutionary. I use it for research. And I can research an investment topic in 5 minutes that would take me 4 or 5 hours. Yeah. So I know it has a value. And therefore, as a family, my son lives overseas and therefore he's able to invest as a family. We've invested in AI. Now, when I talked about special real estate investments, that was again in the context of my son who worked in real estate investments at that point in time. The real estate market in the US is highly developed and highly specialized. So you have REITs, real estate investment trusts, which are very focused. So there can be an REIT which just does malls, or an REIT which just does storage, or an REIT which just does old age homes, and so on and so forth. So, or research labs, or data centers. So if I were to invest in an REIT, I would look at data centers since I believe in. But sitting in India and trying to invest in specialized asset classes in the US is very difficult. So that's not something I'm trying to do. I'm invested in the NASDAQ via the Indian MOST N100, and I'm very happy with that. And the other good thing about being invested through an ETF is that as the index evolves and companies get dropped and new companies get in, it's doing that sifting for you. The losers are going out from the bottom and the winners are coming in and climbing. The only exception to that is, as I said, investing in AI. And people are saying it's a bubble. May well be. You take a risk. There's no point being an investor who's open to risk and not taking risks.
Great. So now, sir, from our heavyweight investment philosophy section, we are now moving to a breezer section now. We would love to know more about your daily habits. And the first question over here is that do you track your investment portfolio, your market one, the listed one, like really regularly, or you are hands off?
No, I do.
Okay.
It's a bit of an addiction. I track it quite regularly.
Okay. So directly via apps, or you have some other means?
No. Just old-fashioned spreadsheets.
Old-fashioned spreadsheets. Perfect. Yeah. Okay. Again, we are talking about the daily habits. So, it's quite regular for us to kind of think about whether we would want to put it as an expenditure or back as an additional saving or investment in our market portfolio.
I think for younger people, these are very important decisions, and I think I do have a piece of advice, which is that I'm seeing a lot of people in their 40s and 50s who earn well but don't have savings. And I think there's a lot of what I call second-hand behavior. So you take on habits because everybody does, and you then end up not saving as much as you would like to. So I'm not suggesting that people should be like me and wear kurta pajama. I'm not saying
No,
that.
Sir.
But I think you need to be very clear about what brings you joy. and what brings you true happiness, and how much you're doing because other people are doing it. I'll give you a small story. I love stories. So when my son was about 10 or 11 years old, maybe 12 maximum, I used to often pick him up from school because I was the head of the Parent-Teacher Association. So otherwise he used to come and go by bus. Said, no chauffeur-driven car, nothing. You learn. And when there were exams and, he wanted to go late or come back early, take the metro. Anyway, so we were coming back from his school, and he was very excitedly telling me about this friend whose father had just bought this particular Mercedes and so on and so forth. He was very fond of cars. So I told him, now, Kedar, supposing I have a pool of money. He used to understand numbers quite early. I said, supposing I have 1 crore of rupees. And let's say we make a return of 10% on that. I just made it easy for him. So we make 10 lakhs. So now you have two choices. And this is your choice. Either we spend 1 crore rupees, it may have been 50 lakhs because this is a long time ago. I don't think a car cost 1 crore rupees then. So you either have a choice of spending the 50 lakhs on the Mercedes or using the 5 lakhs a year to go on a really interesting holiday. So he thought for 2 seconds. And then he said to me, Pa, I think we should go on those annual holidays like we do. So I said, okay, why? He said, after a week or 10 days, that Mercedes will just seem normal. There'll be no memories generated from it. But when we go to these interesting places every year, it will generate memories that will last us a whole lifetime. So I think this was a very profound truth coming from an 11-year-old boy. And I think this is how I would encourage people to think, that this expenditure, which could otherwise be saved and go into my investment portfolio and my retirement or maybe my children's education, is it really adding value to my life? And I'm not suggesting that, you think too hard about life, but these are questions which are worth answering.
No, in between, we really resonate with you when you said that a lot of people in 40s and 50s, they had earned well, but they have not accumulated. They have not even thought. Around 40s or 50s only, we have to retire. And then they start thinking, and then they do this retirement planning, and they kind of, feel a bit of repentance that why didn't they start thinking about their retirement planning a bit earlier. So thank you so much, sir, for all these insights. I'm sure it's going to be super helpful for a lot of people. So very quickly, any closing thoughts from your side?
Well, I'll just re-enunciate what I said, which is that spend money wisely, invest for the long run, don't be impatient, and I would say one of the biggest issues in investing are psychological, and a lot of people, fresh investors, early investors, are the victims of their own psychology, and they often invest because others are investing, and that's typically when the markets are high, and they panic when markets go down, and they exit when the markets are low. And this is very common all over the world. And what happens is that if you entrust your wealth to investment advisors, one of the things that they are trained to do is to balance portfolios against exuberance and pessimism. And so they will do exactly the opposite. They'll buy when markets are low by rebalancing, and they'll sell when markets are high and go back into debt. So we are usually our worst enemies, and having somebody else who prevents us from being that is very, very valuable.
Thank you. Thank you so much, sir.
You're welcome.